Welcome to Lifeblood's MedTech Step-Up webinar, where our aim is to make you venture-backable. At Lifeblood, we understand that transforming a groundbreaking medical innovation into a venture-backable company requires more than just a great idea. It demands the right strategic approach, team, and industry insight. Our Step-Up program is designed to bridge the gap between innovation and investment readiness. We provide early-stage medtech companies with a comprehensive founder-first roadmap addressing critical legal, business, and financial advisory, team building, and marketing strategies. Through tactical step-by-step guidance, we aim to equip you with the tools and insights necessary to attract serious capital and achieve long-term growth. We're excited to embark on this journey with you, turning your medtech innovation into a thriving, industry-changing reality. This is the MedTech Step-Up program. Today on Why You're Not Raising Capital, we are joined by Cristiano Fontana, Head of Advisory for Lifeblood, Joseph Snyder, Co-founder and Head of Talent for Lifeblood, Thomas Busby, Director of Outcome Capital, Umama Ahmad, CEO of 52 North, Tracy McNeil, CEO and President, Materna Medical, and Martin Gomez, partner of Goodwin, who all bring deep expertise from both sides of the fundraising table. Today, we'll unpack the critical gaps that stall early-stage medtech companies and what you can do right now to become truly venture-backable. Let's dive in.
All right, well, thanks everyone for coming today and welcome to the MedTech Step Up program webinar series. So the goal, if you don't know, for the webinar is to more or less provide an educational series within the medtech industry and address the major pain points of the industry. Today, we're going to talk more about the challenges of fundraising within medtech because that's always a hot topic. So Cristiano and I both thank you for coming on, sharing your experience, sharing your wisdom. Each of you have a little bit different experience in your careers, but you've all either been part of raising capital, investing in capital, advising in companies looking for capital. Everything seems to center around money, which is where we're going to launch the program today in order to have some questions about what are the best options, what are the worst options. There may not be a perfect way on how to go about doing capital raising, but there's certainly wrong ways to do it. So diving into some of those. And we are launching a Lifeblood step-up program as well to help with these types of challenges within medtech. So with that, today's webinar will be divided into a couple parts. We'll start off with more directed questions to each of you based on your backgrounds in the first half. The second half is when we'll go into more true or false style questions. It may not be as easy as a true false option, but we'll dig into each of those and make it more of a debate stage to share your opinions and experiences on what the best and worst or better options are based on those questions. And we'll jump in right away, at least with Marty, because Marty, you joined and partnered with Lifeblood a while ago and saw value in the MedTech Step Up program, which this webinar series is aimed at helping within the community. Can you introduce the program a little bit from your perspective and why you thought there could be value in this and why we started it going?
Yeah, happy to. So for those who don't know me, I'm Marty Gomez. I'm a partner at Goodwin. We're a sort of full service law firm, and my group in particular works almost exclusively with medtech companies. And so we help those companies get formed. We help them protect their IP. Critically for this webinar, we help them raise capital from angels or initial sources of capital, and then eventually sort of from institutional funders, and then drive towards some sort of an exit for the company and their investors. And so having been in the industry for well over a decade at this point, we've seen sort of some changes in the fundraising landscape for medtech companies, particularly at the early stages. And given that we are a life cycle firm, me and my colleagues were interacting with lots of early stage medtech companies that were having a hard time raising capital, or they weren't getting enough capital to be able to sort of fuel their growth. I think most folks know medtech is a very capital intensive industry. It's no surprise to me that that money is a common topic because it's needed to develop a product and ultimately to bring a product through clinical trials and ultimately commercialize that product. So many of my clients, particularly in recent years, had been, especially at the early stages, having a harder time raising capital. And we have a vested interest in companies raising capital. Candidly speaking, MedTech companies, in addition to being capital intensive, have a lot of legal needs. And so, we were trying to help our clients raise capital and ultimately sort of support them on the host of other legal needs that MedTech companies have. And we were just finding and noticing that the landscape, had changed, or it was more challenging than it was, say, 10 years ago or 15 years ago or 20 years ago. And so when Lifeblood sort of came to us with this step up program, it seemed like a perfect opportunity. Me and my firm and my partners want to do everything that we can to help early stage medtech companies be able to raise capital. And there's many different components to that, and maybe we'll talk about that a little bit. I think a lot of it comes down to understanding what the investors are actually looking for, what they're motivated by, how and when they want to hear from you. But there's also a legal component to it. And, a lot of that comes up kind of when you're actually negotiating the substantive documentation for financing itself, or the financer is diligencing your company and looking at sort of the legal backing and the kind of underlying of your company. And so we wanted to get involved to make sure that not only are the medtech companies that are going through this program going to be sort of doing the things that they need to do, or at least have the education that they need to be more successful or more likely to raise funding, but if and when they do actually attract the attention of an investor, making sure that they're actually going to be able to withstand and get through the diligence that those investors are going to put them through. So that was our motivation, and super excited to be part of the program with you guys.
Thanks, Mari. Talking about raising capital, Tracy, you are being successful in doing that, and you went through different rounds. So I'm curious to know about whether, the pain that you had to go through in order to be successful changed, and you learn, from experience, and so somehow it decreased with time, or the variables are so many that every time is a kind of a struggle, and one actually is stay the same, and one actually every time is a new experience.
Well, let's see. I just did a close this week. So
Congratulations.
thank you.
Congratulations.
So I think it has mostly stayed the same. I think that the things I learned a lot through the process, and I think I revise my deck every month. Sometimes twice a month, right? It's just the sound bites changed. Someone asked a question that was different than I'd heard it before. So I definitely I try to have a learner's mind about it. I keep it fresh by thinking about it as just meeting people and looking for and trying to find my people. That's really all I'm doing. And 99% of people are not my people. So I think the balance, the thing that never goes away, is the balancing of just letting the person across the table for me be whoever they are, and have whatever questions they have whatever investment thesis they have. And if I'm not a fit for them, still be happy that we met, and think about it from an ecosystem building point of view, that if I'm not right, then I want to make sure I understand their thesis, so that when I meet you and I understand what you're doing, I can make an introduction if possible, because it is a very community-based thing. I think that I get, and then I think the nuts and bolts of how I've kept organized have probably evolved over the years. But one thing I did that I would recommend, and has not changed, is I keep a lot of notes of the conversations, and I still have my notes, because you meet them again. A lot of funds will meet you several times before they invest, or never invest, and they still will meet you several times because they're following you, or they think what you're doing is interesting, or they like you, or whatever. And I think that taking a minute to figure out who they are, where they live, do they have kids, well, what's stressing them out, those kinds of things. I take notes on that because I find it matters when you circle back and, oh, your kids must be what, 4 and 6 now, or, that kind of thing. It really makes it more fun for me. Right. And I think probably makes it a little bit more pleasant for the person across the table.
Yeah, I see that. And so talking about this learning process that is kind of steady, I would like to ask to Maima, you also recently closed a round, and I've been also, kind of part of your journey. And my question would be, in terms of learning and in terms of your ideal plan that you had at the beginning and the type of investor that you ended up with closing the round, how different it was, and if it was so different, how you could manage, from your ideal picture to what really happened at the end, being successful.
Yeah, and it's a really good question. So from my perspective, when we went into the round, we had a pretty clear vision that we wanted a good mix of sort of strategics, people who brought value alongside capital. And I know that's something that probably everybody says when they start. But in a market that's tough, sometimes, as Tracy's saying, you've just got to take conversations. Some of them aren't the right fit for you, and you begin to feel that. And I think as we went along the journey, we found people who had that ability to add sort of strategic expertise. And specifically, I think there were two things that changed from the start to the end. One was that we never really thought that we could get venture funds linked to hospitals. So we ended up having our round co-led by a US linked hospital linked fund and a UK hospital linked venture fund. And we didn't really think that could happen. It was the first time it happened. And so that was a surprise. It wasn't something we set out to do, but it was great because it covered the markets. And that was one core piece we were looking at, was we wanted to ensure that our two key markets were covered by our investor base. The other thing that was not necessarily planned was that we ended up getting a lot of high value add angels. And for this type of round, you don't typically expect angels to be a core part of a round. It's typically institutional investors and stuff. But what I found was actually, their ticket sizes were not as big as the institutional investors, but the ability for them to then step into sort of advisory roles and give credibility as a sort of strategic support to the company was huge. So one example was we got the former CEO of Roche Diagnostics as an investor, and so he's an advisor now as well. And the ability for that investor to go into forums with his sort of counterparts and talk about us with credibility means a lot. And that was definitely not something I really thought about. But it took a while to get there. Obviously, you have to build relationships with these people and get them on your side before they're willing to put their own money in and then support you. But I think that was probably the biggest surprise, is realizing that actually there were probably 2 or 3 other individuals as well who, not the bigger ticket sizes, but their expertise in sort of M&A licensing, this kind of area, and thinking about how we can strategically grow as a business is going to be just great, having their support as individuals, because sometimes it's the smaller investors or the people who are smaller teams who are actually more active in engaging on your behalf when they go out to conferences and things like that. So I think overall we definitely got what we wanted, but probably a bit more than we had hoped for strategically.
That's great.
That is interesting. And you both, I'm sure, developed some scar tissue from this. I know, Tracy, we've talked about that before as well, where it comes with the territory. If you're not scarred, you're probably not doing it right along the way. But with this, I've heard different things as far as raising capital, where sometimes it's more analytical, sometimes you have to put on the sales hat. But at the end of the day, what you're really doing is you're selling a piece of your company for millions of dollars, and trying to get somebody to buy that portion of your company. If you look at it from that lens, is that something that can be helped then from? I mean, Jemima, it sounds like you found a good advisor. But if you're raising a Series A and it's coming from VC, it doesn't necessarily mean you get a board member that is supportive, industry specific, helpful in that sense, but you will get a voice in your ear at the end of the day. So how do you properly manage that in finding the right type of money, bringing that on?
Well, I think it's important to ask for what you want. I put together a matrix. I tried to keep it because it can get personal. And especially if you're not with institutional investors, well, institutional investors have their own thing, like, 'cause they've got the partners they have. But then I think angels also, if you're early stage, angels can want a board seat, and they may or may not be qualified to be helpful. So what I did was I put together a spreadsheet of things that Materna needs to be successful. And I ranked them in importance, and said how many people on the board would need to have something like this, right? Because you do have a mix, and it's better, I think, if the board doesn't all have the same background. Parenthetically, you didn't ask this, but the biggest issue I would see with a board is if they have diverse financial interests, right? Because it can happen over time. It hasn't happened to Materna, but it can happen that your early stage investors have very different opinions about what constitutes a good deal than your late stage investors, and that can be a catastrophic problem, and needs advice from people like Marty to avoid things like that if you can. But I think in terms of helping people understand their lane, also having a spreadsheet like that can be helpful. Like, so for example, if you have someone who's really kind of a finance person, they're probably great on your comp committee, right? And then they fill out the thing and it also calls them out at their best, right? They can show up saying, like, I'm good at these things, and then you have a place to put people.
Tom, could you touch on that then? Because Tracy teed you up from the other side, whether it's investment banking, investing directly. How do you provide the right type of value there? How do you make sure the investment you're getting into, you can actually support and help? What do you look for from that angle?
So at Outcome Capital, we primarily cater to more growth stage companies. And we can talk about sort of capital raising has changed over the last decade, because I do actually think there's been a lot of changes there. I would argue that there's more transparency in the markets than ever before. So it wasn't, 10, 15 years ago, PitchBook was really just coming around. So if you wanted to find out, hey, who are the biggest MedTech investors that I should talk to? And then who are the partners? There was no centralized database to find that out, to find out who does this. So 10, 15 years ago, if you had a MedTech CEO that wanted to raise capital, there was really two ways to do it for your Series A. One, you've done it before. You know who to call, and you make those calls, and you do a $5 million Series A on a $15 million pre. And I see Marty shaking his head. I see Tracy shaking. That was what everyone did 10, 15 years ago. Now you have, I think, a few things. One is because of 510K pathways, you just have more MedTech companies in the world than there ever have been. Also, the cost of innovation is arguably cheaper than it ever has been. And now with market transparency, you can find out who raised what round, from whom, when, what was their pre-money. And you have CEOs shooting from the hip to reach out to every investor they can and have those conversations, arguably, Joseph, oftentimes before they're ready to. And so to Tracy's point, you are oftentimes, venture capitalists, sometimes I think we think of them almost as these gifts of God from the heavens to find the world's greatest technologies to help humanity. And many investors get into it for that reason. But we don't put nearly enough weight on the second word of their title, capitalist. They are here and bound by a fiduciary responsibility to create a return for their LPs. And so I don't know that as many MedTech CEOs appreciate what sort of pathway am I going down, what return do I need to get to actually make investors excited. So that's where, Joseph, I'd say too, in terms of sort of what's changed. The demand for VCs at a Series A and Series B, and Tracy and Maya, I'd be curious on your thoughts, to have a totally clear commercial pathway and understand what market share are you going to get and who is your acquirer. And if that doesn't happen, how do we do dividend distributions? And if we don't get acquired, then who's the private equity that's going to do it? It's conversations that are 3-5 years out and not about the technology, because they assume it's going to work. And so that's where I think, again, to Tracy's point, have your notes and be ready. If you're going to be aggressive on revenue projections and you don't hit them or timelines, you're going to have an uncomfortable conversation at LSI the next year when that, person says, hey, did you hit that milestone? So that's where Joseph, I'd say the transparency has made it so that CEOs really need to be far more thoughtful of interactions with capital providers.
So Tom, I really like the concept of saying that basically knowing people nowadays is not the problem anymore. Like you can find those information. Probably, of course, having a relationship is super important still to get the warm intro, but I've been talking with different VCs about that, and they all told me that, the major reason for a no, it's always a lack of understanding the matrix and in the potential and, really what the project in terms of ROI could have given back to them. And I could not be more agree than what you just said.
So
I also vehemently agree. I think you said it very well, and I've observed the same thing in a lot of early stage companies. The CEOs don't have the perspective of starting with the end in mind, and they don't, and they get, and this comes down to value. This happens at valuation too. They want to get a big valuation, which is understandable, but I think that it can be very counterproductive, right? Then you run out of headroom if you don't really understand your exit comps, and you've raised too much or you've raised the right amount at too high a valuation. You got to pay the piper at some point, right? And what I would want to avoid is becoming what I call a zombie, where you get to a stage, but you can't raise any more money and nobody wants you. But then you're stuck with this company that's going nowhere. It's the worst thing. So I wish that I'm glad Lifeblood is doing this, because I think it is not something that they necessarily even teach in business school, is how to do the multiples. I have a simple little calculator, and people can reach out to me on LinkedIn. It's a very, very simple version of a waterfall, but it just helps you think through what you're going to need to raise to get to what, and what kind of return that would be for somebody else.
And that's what returns people want. So I run into that all the time. Of most CEOs of MedTech companies are MD, PhD, some type of technical orientation. And so when it comes to the business side, sometimes they undervalue corporate finance and some of these things. But not every company can have a $500 million, $1 billion exit. Sometimes a $60 million exit is fantastic. Also, because not every market is a $1 billion market. And that's where CEOs, I think, need to also be prideful of, you might only live in a $300 million market, but it's very underserved and you have a great opportunity to grab it.
And that's part of why the Step Up program was launched. And I'll ask Marty about the legal side and the cap table side and the board dynamics and all of the back end IP. But that's why Cristiano's been doing this for years now, with financial projections, true competitive analysis specific to the medtech industry, working on the marketing and the market access and the reimbursement. Like, if you don't know how you're going to get paid, where you're going to get paid, what the margins might look like, it's going to be incredibly hard to raise capital in today's market. We saw that come to fruition when there was a crazy amount of SPACs a few years ago, and everybody seemed to be getting money. And then how many of those companies still are around today? But Marty, when it comes to Tom mentioned the board, and you're more early stage than where Tom generally is if he's growth. What are those pitfalls where it could be poor financial management, poor IP strategy? I know is your specifics, but what do you see that really has companies hurt themselves in these early stages when they raise this capital and try to build?
Yeah, so I think it's it varies by company, and to be totally honest with you, the legal mistakes that get made, and they're legion, but they usually don't surface until you actually get one of these investors interested and they get into diligence with you. And that's actually kind of the worst scenario, right? Because you finally, sort of done everything. It's a very difficult ecosystem. You finally get one of these institutional investors interested in looking at the company, and you've kind of hit the other milestones that you need to hit, right? Which, as we've discussed over the years, have moved downstream, right? So we used to see institutional investors investing in preclinical companies. Now, oftentimes they're looking for some sort of, first in human data. Many times are looking with an eye towards reimbursement and commercialization concepts. So, you've sort of gone on this journey. You've finally, sort of gotten the attention of this investor, but then usually the way that it works is it's those kind of high level benchmarks that will lead to sort of a term sheet, but then the investor will get into diligence and they'll see, that the cap table doesn't sort of support them being able to come in, and they will model out. I mean, I think a big takeaway here is financial modeling. Understand what motivates these VCs. The VCs will understand maybe that there needs to be more capital to ultimately come in before this company is going to realize an exit, and they're going to get a return on their investment. So if the cap table is kind of over full or messed up with lots of what has become sort of fragmented early stage capital in the medtech space on, safes given out with, improper valuation caps, right? Or options, given to employees that, sort of ultimately won't work. Those are the sorts of issues that it's a real shame because, you have sort of satisfied all the other things that the VC wants to see, but they'll walk away from the deal because it just it can't work financially for them. So those are there's lots of different issues that come up. IP is another big one. If you don't have that buttoned up, that can be an issue. If you don't have agreements in place, with the right sort of terms in them, lots of different sort of legal diligence things that seem you can sort of convince yourself in the early days that they don't need to be perfect, and you can sort of fix them later on. And that's true for some things, but it's not true for all things. And that is what we're hoping to avoid with the Step Up program is companies finally getting to where they need to be, but legal issues preventing them from going further. Because frankly, the institutional VC round, it's happening later than it used to, but that is not the end point of the company's history, right? That is an inflection point that it needs to happen, but it's not like, okay, we've gotten to the institutional raise, we're done, right? There's a lot more work to happen after that, and we want to make sure that the company's positioned to be able to do that.
And Marty, I think we run into this. Too many CEOs sometimes when they get in the meeting with the VC are so like, oh my God, if you could just invest in us, everything will get better.
Yeah.
And the VC is going, no, I'm going to invest in you. And then everything gets harder. Like you don't get it. Because up until this point, you've only had to worry about developing the technology. Now you have to worry about hiring people. What is your COGS? What's your reimbursement pathway? What's your regulatory pathway? What is the commercial needs? And so I think too that CEOs need to be careful about wearing their emotions on their sleeve and seeing this meeting as you are a stepping stone for me to get to my next step. Because the VCs want to be viewed as that. They're not your home. No one's making money on the VC investment. It's the exit.
Yeah. Right. And Cristiano, I'd like to ask you on this too, because you have an interesting background where you've built a startup, you've raised capital, you've been an investor, and then you've gone on the advisory side, helping companies do all of those hard things that you've done already. So what are some of the things that you see done? Is it a combination of everything that's been brought up here? Is there the more common threads you see, whether it is the financial projections or targeting the right market or thinking that, a slide deck is what's going to raise you capital and nothing else? What have you seen?
Well, I think it's a sort of a combination of all of these. And I think we raised a lot of good points, and I'm also happy now we're going to move in the more dynamic part of the webinar, and some of the questions somehow are kind of, leading toward some of the topic that we already discussed, but it will, be nice to debate a little bit more. It's a combination of every factors. Even talking about financials, I always say financial itself, right? They're not, it could be wrong, but there could be some guess, but I always use financial to find the consistency between the financial and the storytelling. I use financial to check if behind every number, there's enough information and people are ready to address the question about those informations. Being flexible is one of the most important things. And again, understanding the metrics and the ROI is still probably, and understanding the valuation, the current valuation, what will the company may value and worth in the future, and what is the worth for the people that are in front of you and you're pitching to. That's the most important things. I would say I work with hundreds of different technologies and projects. Of course, I have mine. I'm investing in others, but I hardly remember some project or technology that I thought this is a bad idea. It's always never a bad idea. They're all good ideas. What really differs and what makes the difference is all what we are talking about here is about understanding how to, backing up that good idea and that good technology with something that will be compelling for other people to jump on board. That's my 2 cents.
If I could just add in there, so obviously, Cristiano, we work together on building the projections for 52 North and thinking about valuation and things like this. And I think that from my perspective, there's probably sort of 2 really major red herrings on the side of the startups. One is thinking too much about valuation and not thinking about what happens after, and kind of being stuck to an arbitrary number, not understanding the market or taking that into account. A good VC will not want to drown you out by taking so much of the company that you can't raise again. So you need to always kind of take into account that there's a perspective to this. They're thinking about what else you need to raise, and having done some of these financial projections or looking at the ROI, as Tracy mentioned, for the investor is a really cool part of that. The other thing that I've seen is more on the legal side, but I've heard a lot of people, a lot of founders say, talk about sort of percentages of company ownership, and after a certain round, there is this conception in their heads that actually when you go sort of 49, 51, you never want to go above 49% because then you lose control of your company. Now, this is a complete myth because, and I can see Marty, you're smiling, it's probably something, I mean, the rights are written in the documents. You can own 80% of your company, but if the documents say that you can't do X, Y, and Z without investor consent, then you're not in control. So I think there's a lot of sort of arbitrary pressure that people put on themselves over things like this, which aren't really correct. So I think getting advisors around you to support you with understanding how people are seeing this outside of your sort of founder, CEO, C-suite level, and looking at people who've done this before, or people, on either side of the transaction is super important.
Milo, if I can, I think that's a great point. One of the things I suggest to some of our client CEOs when they're getting ready for these discussions is I say, go and listen to some of your favorite public company CEOs do their investor calls and hear the questions that they get. Because they're not, certain questions go to the CTO, but other questions go to the CEO, and that's on the investors and how they're being taken care of and considered and margins and growth. And that's also where I think, Joe, where companies tend to fall down sometimes is you outgrow your team very quickly. And so it's also realizing as a CEO, I got into this because I love the technology, but now I really need to put my business hat on to be a chief executive officer. And that's a different sort of skill set that I need to lean into. So to Lifeblood, hiring is a big one. For investors, it's market, technology, team. Do I like the market? Do I like the technology? Is the team there? One of the things that doesn't get talked about enough is behind closed doors, you'll hear VCs say, I love the market. I love the technology. I just don't know if that CEO is going to be the person to hire the rock stars that they need around the table to really bring this company to its next level. And that's a CEO really embracing who they need to be in that moment, I think. Not who they think of themselves as 2-3 years ago when they started, but who am I now and who do I need to be and how do I need to project myself?
I like
Good
it.
points.
Cristiano, I believe we're at the time where we'll pivot to the second part that we'd mentioned, where it's more of we'll ask true, false, and we'll ask you to vote, and then we can elaborate as needed, because I don't know if these questions will factually be as easy as saying one way is right or wrong, or one question is right or wrong. So if you want to tee those up, Cristiano.
Yeah, and something that I want to just say before that is that nobody here beside me and Joseph are aware about the question. So it's good, and let's agree to disagree in case. So I will read the question for the audience. and you should receive it. You can vote, and then we can see the results and discuss it. And you will see there is a right answer, which actually just because the system works like that, but there is not. So raising money with less than 6 months runway is almost impossible. All right, let me reveal answer to you guys. So we have 60% true and 40% false. And so I would start from who said it's true? I mean, why is true? Why is it impossible? Okay, Tracy.
I said it's true. It's not totally impossible. I would say it's improbable. I think there's a couple of things. Well, I think it also depends. So all the false people are going to be like filling that out. But I think that the biggest issue is that their investors will be skittish that you're not gonna make it. And so they've got a lot of deals that they're looking at, and the ones where you're starting with plenty of time, you're building the relationship, you're giving them space, right? Like, unless you're something very, very exceptional, which most of us are not, you're going to be something interesting for them, but they've got a lot of other things that they could do. And so I think your insiders are a different story there. But I think if you're going to try to go from zero to investment inside of 6 months, I think it's very, very difficult.
And what can I say about what I can say? Sorry, about all the people that we work with in terms of fundraising and Lifeblood. People come to us, the big majority come to us when they have less than 6 months runway, asking for help. And I see what they're saying. I totally agree with you, Tracy. I think nothing is impossible. But my point here would be, you don't have to wait to plan your fundraising and execute your fundraising strategy when it's too late. And again, it's never too late. I've been successful and supporting successful raise when it was, the company always was put in standby, but you put yourself in a difficult situation, in a difficult process, right? It's already a super difficult process, and you put yourself in a difficult situation in a hole. But it can happen. Someone who said false.
I said false.
I also said false.
Yeah. So I said false. And again, I think you were very smart to write these questions this way, because, I think it comes down to, almost impossible. What do we mean by almost impossible? It was a smart question phrasing, but at the end of the day, I actually, just looking back on and I also think Tracy's right, by the way, the way that I interpreted the question was sort of new capital, because I think quite frequently we do see, sort of existing, investors bridge a company or something when they have less than 6 months capital. But the way I interpreted the question was sort of like getting a new investor to sort of sign on with less than 6 months runway. And I guess what I would say is, like, in my experience, maybe out of 100 financings that we do at Goodwin, maybe 10 of them, the companies have less than 6 months run rate, right? So whether or not that's almost impossible or not, right? But I think what I would say, I think the takeaway is, to Tracy's point, right? Unless you're, I think we do ourselves a disservice by, especially given how difficult MedTech is and entrepreneurship is in general, to look at, like, well, what is possible, right? It's like, yeah, maybe it's possible, but we really want to play the odds, right? Because, like, there's enough other challenges in front of us anyways. So yeah, 10 out of 100, maybe they do have less than 6, months runway, and they're able to sort of get a new investor on board. But do we want to bet on that being the case? Probably not. But it does happen. It's just, if you're running a company, do you want to sort of give yourselves the best odds to succeed and start that process before you have less than 6 months runway? Or do you want to put yourself in sort of that, challenged situation of having to be, the 1 in 10 times that this actually happens?
Marty, can I challenge that? So when you said, and I think it comes down to the phrasing of the question again, when you said they come to you guys with less than 6 months, 1 in 10, is that coming because they need a term sheet looked at, or is that coming to, because surely they're coming
Great question.
Because I would say that they probably started that journey way before and only got close to closing at 6 months or less?
Yeah, good. Yeah, that is a great question. So if we're doing it right, if we're doing the relationship the way that Goodwin likes to do our relationships, we've been with the company for many years, sort of actually in advance of sort of this institutional fundraising. So I am actually speaking to, there are circumstances. I'm not, whether or not the definition of a cold start, I guess, is like, have they like been sort of like putting out feelers or whatever? But no, I'm saying that I have seen situations, again, maybe 1 in 10, where a financing can get done from a cold start within 6 months.
Would you say?
I'm gonna. Oh, sorry. Go ahead, Uman.
Oh no, I was just going to ask. Would you say that the startups that do this, that 1 in 10, lose their leverage though? Because how much can you really negotiate when the other side knows, and they'll have seen your finances as a company, that you've got runway left?
Completely, absolutely. But there are situations, right, where like, again, we've all like the technology is just perfect. It's exactly what this institutional investor is looking to invest in at this particular time. It fits right into their portfolio, and they, that maybe the sometimes, I think everyone should be aware of this. If you have like a sort of a serial founder who has had sort of like past success, now, again, whether or not a founder like that gets to a situation where they've got less than 6 months runway, there's lots of different permutations and iterations of this. But yes, 100%. I'm not advocating that one try to raise money with less than 6 months runway, because I think first of all, I think that there's a good chance that you don't get it done. And even if you do get it done, to your point, you're probably going to end up with terms that are less favorable to you than they might otherwise have been if you had come at your financing from more of a position of strength.
I would say
we can. All right, sorry.
I would just say that the other exception, I would say, is if you're doing a convertible note with angels, and you need an amount of money that will meaningfully get you somewhere with the amount that angels can get you. I think that can get done in 6 months.
Right. So I think we can go on for under 10 minutes, but let's move to the next question.
I really enjoy people disagreeing with Marty too. So the my one,
That's what I do for a living. So
and
people disagree with me all day, Tom.
Well, I was going to say, Marty, taking questions. I know you're an honor roll guy, so I know that you're going to get them all right. So
that's why we came out with the format. So next question: your round valuation would be imposed by the investors. So we have 80% false and 20% true. So I would like to hear who stands behind the two.
So I'm trying to be a little interesting here.
All right.
Tom's got my backup. So again, will be sort of imposed by the investor. I think that probably what others will fill out is that there's all sorts of things that you can do in your company to position it for what the evaluation is. But I will say, I just want to make the point. Most of the times that I see this happening, right, there are some soft discussions beforehand, but the first time that a real valuation is actually put on paper is in the term sheet that is served up from the investor. And so in some ways, right, that's the first time that I often see it. Now, can you negotiate it? Sure. But the reason I said true is they're going to have a view based on what the company has done, and they're going to be the first ones to put it in the term sheet, sort of what they think the valuation of the company is.
I will say, if you combine this with the last question of raising capital with the 6-month burn rate, this would be an easier true.
Yeah, right. Yep.
So if I can here, being an investment banker, I think I'm beholden to my profession to say that bankers set the valuation. Kidding aside, I actually have to half agree and disagree here, because the valuation will likely be imposed by an institutional investor. And that's what you want. You want a smart investor to price the round smartly. But more than valuation, it's about structure. Does the founder get founder shares? Are they preferred shares? Is everyone going into common? What are those break points? Are you sitting alongside your investor or behind them on the cap table? What are the tax implications when you exit? Founder shares are worth a whole lot in certain, and so You want institutional to come in on the valuation. Then it becomes the transparency of having an advisor can be helpful. So that is where a good banker will say, your terms are not market. And we appreciate it, appreciate the interest, but we just need to be looking ourselves in the mirror right now. You're off market on the valuation, and here's why. And how do we arrive at that valuation, and so on and so forth. So it's imposed by the investor, but it has to be accepted by the CEO and the board. And so that's where, too, I think far too many CEOs are too sensitive on valuation and not structure. And not to be pejorative, that's born out of naivete and understanding corporate finance.
When I think that the word imposed, you might be able to use that more for a lead than the investors as a whole. But the way Tracy phrased it early in the discussion is this is a negotiation, and the best way to present it, Tracy, you can jump in, but you have to say, here's what will help the company succeed, and this is what we need. Where if you don't follow those terms, the investors then are setting the company up for failure, which is why I voted false for this one.
I think echoing what Tom was saying, I think, and to close this, I think you need to have a strong backup information, a strong positioning on the valuation, and then the price that you negotiate can really depend on the negotiation itself. But as more you know about why you would like to have a certain valuation, why your company should be evaluated in a certain level and threshold, the better it is. And then, of course, negotiating and someone that put some money, but it's not just about price, it's about governance, it's about everything that we discuss here. So it's a good argument.
One last thing, if I could hear,
Yeah, please.
because it's a market, it moves up and down valuations, and CEOs will oftentimes try to pull valuations from years ago. So, for instance, things were frothy in COVID times. It was free money. So valuations now are creeping down, but that's not a bad thing. And that's where, too, I think CEOs need to be a little more open to kind of where the market's going.
Totally agree. Next question. Your data room should be ready before an investor shows interest into the project. All right, so we have the first unanimous verdict. So my question would be, why so many times it doesn't happen? I mean, why many people do not prepare properly or do not build their data room before going out and outreach?
Is that true?
It is. I mean, based on experience. Yeah.
It's people putting the cart before the horse. It's what Thomas said earlier. It's naivety. It's people being keen to get out there and talk to investors and not realizing if you get a hook, if you catch a fish on there, you need to move quickly. You lose your momentum. And if you don't have that beautiful data room organized with everything that they need when they need it, it's just going to wither the relationship. But I'm not surprised to hear that many people don't, because it's exciting to talk to investors. It's not exciting to set up a data room.
Or the data room is just internal corporate files that you open, and not the curated, up-to-date list, and it goes vastly undermanaged and unrealized. It's really an investor's first experience of, are they organized?
I think it's I feel really strongly about this. I guess I used to be a lawyer before I did this. And so I felt just the organization of having a good data room, it just tells you so much about a person, and being able to keep it up to date, having, just showing that this is how you run your organization. And that's also your first impression, right? It's the first time you get to show the investor how you operate as an organization. And it's a really big opportunity, and to not have that prepared beforehand is a massive faux pas.
As a banker, I'm leery of taking on an assignment where the data room isn't somewhat ready to go, because it's an indicator of we're not even going to be ready to talk to people for weeks and months.
Yeah, and I think it's and that's my experience too, is that they're usually, somebody will say, oh yeah, we've got a data room ready to go, but it's just their Dropbox folder that they put everything in, in the entire company. It's not curated. I will say, part of this, obviously most of this is supposed to be educational and helpful to folks. Like, we get it. They're like being the CEO of a medtech company is difficult. You've got a lot of different things going on, like at any given time. But I do think that this is valuable information in that sometimes it's like somebody says, well, I've invented a new, device to replace a valve in a heart, right? Like I can put together a data room, but it's silly sometimes. It's like, this is the kind of stuff that actually can make a difference at the end of the day on whether or not you get a deal done or not. And it's not rocket science, but it's just sort of some of that mundane kind of organizational stuff that, you need to have the great technology. But again, as Tom said earlier, the investors almost assume that you have the great technology. It tends to be this kind of organizational stuff that can, it's not the end all be all, but it is, can definitely make the difference between something being successful and unsuccessful.
I think it's a fair time to quote Logan Roy from Succession for anyone who's seen it, where he says, "You're not serious people." And I think that's what you say when you don't have a data room ready.
I love that show and that quote. Thank you for bringing that to this webinar.
I know we have
Sounds really tough, but it's so true. It just, and that's where if you're talking to a venture investor, their returns are different than growth, they're different than private equity, and just go start reading the Wall Street Journal.
Well, I think the challenge we have working with a lot of startups too, though, is they think they have their data room prepared, but they don't have the right people telling them what's missing. It could be the financial piece, could be the business plan. They might think the legal side is buttoned up and their pitch deck's good, so data room complete. But all they have to do is miss one component that's important to the investor within the data room, and that's when it falls apart too. So part of it's a lack of education or not knowing who to ask or what to ask.
On the serious people point, I do think that it's worth it here to draw a distinction, and everyone should understand this. In the medtech industry, as we all know, is kind of its own unique animal, and we've talked about sort of investor preferences and all that kind of stuff, but it's a pretty serious industry too, right? We're making products that go into humans and treat health conditions, and so the same standards may not apply. I think a lot of times in sort of VC culture or Silicon Valley culture here in the United States, kind of the move fast and break things philosophy can kind of take over. And it's like, well, we're just, we don't have all of this X, Y, and Z buttoned up, but like we're just moving fast and we're driving through this. That can work in some industries. It doesn't work that well in medtech. I think the investors want to see that the people running these companies are serious people.
I agree. And just to give a dissenting perspective, I will say that it is possible that your data room will evolve during diligence, right? That people will ask questions that you hadn't thought of, and it's not the end of the world. It's like, oh, I didn't realize they'd want to see that. Or the other thing that I can say is that different types of investors will want different things in the data room. And that's both on your team and outside your team, right? So when a company is earlier and has angel investors, the data room might look like one thing. When you've got institutional investors and private equity on your team, the data room might look like something else. And so I think it can be collaborative. It should be collaborative, the creation of the data room. It's not all on the CEO.
So we make the analogy, Tracy, that your data room is almost like a data house, where similar to when you have guests come in your home, you don't bring them up to your bedroom immediately. At least I don't. But you start in the kitchen and the living room and the TV room. And the same way, it's okay to have a data room and say, I got to open up your data room and call it a preliminary data room. And have in there just your basic docs. It shows more sophistication. And then when someone's interested, you say, oh, now I'll open up HR. I'll open up more my clinical side. That's the sophistication I think that investors want to see, not just, hey, now they know everything that I've ever done. Because that investor's going, well, who else have they shown this to?
Great point.
Right. So I think we have a few minutes left. So I will go with the last question, which actually is also my favorite one. And then we can wrap up. So the size of your team will be the main attraction for investors, true or false? And I'm going to explain why is my favorite one. So there's just one, reveal the answer. There's just one true, and I hope it's Marty. And
Not this time.
All right. All right. So I did just to get it out. I think that a wrong TAM is probably what I see most of the time as the problem in the pitch deck, which is actually for me the main issue that I always try to solve, because it's strictly correlated with the fact that you cannot describe well the opportunity if you cannot describe well your market, right? So, and people actually, I think that people tend to just put the highest number possible, when I always say, well, of course, there are certain threshold that investors look at, but it doesn't have to be massive. It needs to be correct. And trickling down from the TAM to the sun to the sun, it needs to be consistent, right? So what do you think about that? Any comment?
I totally agree.
I think true. Yeah. Tracy.
Well, I'll just say, I think that I think of the TAM as a gating factor. Like, if your TAM doesn't work, if it's not correct, if it's not big enough, if it's going to take more money, if you're the sixth entrance to a market that's only, $200 million to begin with, that kind of thing, they won't care about the rest. But I don't think it's the main attraction. But I want to hear what Tom says.
So if the market my experience is, investors start with the market sizing activity, and then it's less the TAM and more the SOM. What's the obtainable market that you can grab? But I would actually say, Tracy, and I hold this pretty tightly, that most investors start with, I can only invest in markets of a certain size, because only certain size markets are going to yield a certain size return, and only certain size returns are going to be acceptable to my LPs. So I'm thinking of groups like a Bain or a Blackstone. If you go to them for a $10 million, $20 million raise, they'll say, they might laugh, but they probably won't, because they're kind people. If they put in 20 million, there's not enough of a return for them to really make a difference. So at minimum, they'll do 50 or 70 or 100, looking for that, $500 million return. There are other groups that say, no, I only want to play in $200 million markets that are so. We brought Chris Mathia to the Lifeblood conference. We sold him to Cardinal Health. He works in a small market, but he was the only one of his kind. And so that deal moved very quickly. So that's where, for instance, had peripheral artery disease, huge market. But the world doesn't really need another catheter. So you might be attacking a very large market that's addressable, but obtainable is like zero, because you're not going to dislodge those entrants. But I do see investors starting with, what market do you play in?
And I voted false, more or less for the reason you said. The obtainable market matters, and having that identified properly. I think the challenge, and the main reason I put false, is people that come to us to help them raise capital, they'll showcase the hell out of the TAM without any meat underneath it, thinking that's all that matters. And they don't have anything about their competitors, what's in the industry, who's close to market. They don't know what's actually happening there. So they're trying to portray it like it's their market to lose, and it's the wrong focus for the investors with how it's pitched. But I think the obtainable market is really what matters, because are you first entry, are you fast follower, or like you said, are you another catheter in a flooded space that you have to try to break into, and that matters. But I know we do have some hard stops on the clock today, so I do want to thank everybody for taking the time and jumping on the webinar today, the MedTech Step Up webinar. This is the first one we'll be recording. We will continue to do these throughout the year with different topics. So thanks again, and we'll have all the bios and show notes in the link once this is up.
Hey, Joey, if I can, as the proud father of a daughter, and we read Lena Mo, CEO, every night, I just want to say it is such a joy to be with Umaima and Tracy as female CEOs. You are the role models that my family looks to, very truly. So thank you.
Thank you, Tom. I appreciate it.
Thank you.
To explore more topics like this, head over to our website and dive into the full MedTech Step Up webinar library. Whether you're refining your go-to market strategy or preparing for your next raise, you'll find practical, founder-first resources to guide every step of the way. Visit lifeblood.com to keep stepping up.